You pounded that Fairlife. You need a minute to breathe through it?
Nope. Let's go.
All right, Fairlife.
Fairlife's good. I'm ready.
Waters?
Check.
Good.
I'm good.
All right.
All right.
Good morning or good evening, everybody. Whenever you are listening to this is the HIG podcast. I'm MattyP, here with the one, the only Bronson Kaufusi. What's up, Bronson?
Hey, what's going on, everyone? Good to be here.
It is good to be here at Harris Financial Center here in Provo, Utah. And we are here today joined with one of our most favorite people, a man that I am lucky enough to share the first name with, Matt Denning.
I'm lucky to share it with you too.
We just become best friends.
No, that's been a while, but stop holding my hand. I told you, we don't do that in the podcast.
Matt, he is our infinite fountain of knowledge when it comes to anything in the market, anything, financial or investment related. He has an answer for anything. And if he doesn't have the answer at that moment, he'll say, give me a couple minutes. Let me do a little research, and then he always comes back. Which
may not be a good answer, but there is an answer.
And one of the best things I like about Matt is he won't tell you what you want to hear. He will tell you just how it is.
I love that.
And there's a lot of value in that.
It's true.
A whole lot of value in that. It's just pure truth, a capital T truth.
Matt, I'm tired of hearing you talk right now.
All right, well,
I think we need to move on.
Maybe a little bit more background about Matt Denning. He's our CIO on Wall Street for over 20 years. We met out there when I was in New York. But I am as well very impressed by Matt and all the awesome
Bronson, I'm tired of hearing you talk as well.
So,
all right, bring us home, Matt.
he's got
It's all you. It's the Matt Show.
Let's move on.
It is the Matt Show. It is the Matt Show today. So, but we have a lot of questions for you, Matt.
Okay.
A lot of listeners I've talked to that are listening to our show, they really enjoy listening to you talk about the markets and different things. So maybe could you just give us maybe a broad overview of, the current markets, kind of where we're at today, and then also, 2025 is right here, right now.
It is. Well, a lot of our conversations here start around interest rates. It seems like interest rates, inflation, and then it was elections as well, which obviously are behind us now. So there's a little bit of clarity there. But I think those are three big picture topics we can discuss and then fire away with any other areas that you think you may be helpful. But speaking about interest rates, I think I was here a couple of months ago and talked about how there's this disconnect with people who aren't investment professionals. And as they think about interest rates and they hear that rates are going down and the Federal Reserve is lowering rates, they think that all types of rates are going to go lower. And I said, no, you need to understand that different loans are priced off of different tenors, different market durations. And so just because the overnight rate that the Federal Reserve is cutting may be going lower, that doesn't necessarily mean that your mortgage rate is going to go lower, which that prices off a 7 to 10 year time horizon. And so as you've followed over the past few months, we've actually seen interest rates creep higher in the what we would call the longer out on the yield curve. Overnight rates have gone lower, but if you look at 5 and 10 year rates, those have crept higher. And so I believe I brought up the question that all of us have as to what is the new normal for long-term rates. What is that? Is it 3.5%? Is it 4%? Is it 4.25%? And that's going to really dictate where you see, or it's going to be a big driver as to where you see interest rates move to. The interest rates that impact most of us.
Yeah.
Now, overnight rate, that is definitely a big deal. It drives your money market rates. It drives loans that are based on prime rate plus. And so I'm not discounting, the degree to which we want to follow that and see what happens. But more things are priced off of 5-year and 10-year rates. What we do in the institutional space, a lot of loans are priced off of those yields. And so we've seen those yields tick higher over the last couple of months. There's a question mark as to where this will settle out at. I always caution those that are following markets that they need to understand how momentum trading in the market impacts pricing. In the near term, well, I should say in the long term, we have confidence that the markets will get things right. But in the near term, there are different investors that have different approaches to investing that can drive and move pricing. And so you have a lot of trading strategies that look at price momentum. They just look at trends in the markets and they trade those trends. And so you can see even in interest rates, which is the most liquid market in the world when we talk about bonds and rates, that can be influenced greatly by price momentum trading. And so we saw rates tick higher, 5 and 10 year rates tick higher over the last couple of months. It seems like it's settling down now. And I think that now there's a question of inflation, how that's going to influence interest rates. And I'm also here wondering where we're going to settle out. I don't know. I was hoping we'd settle out in that 3.75 to 4% range on the 10-year. It's higher than that now. It's creeping up. It's over 4.25%. It's creeping higher to 4.5%. I think it got to almost to 4.5% a month or so ago, as I think a lot of price momentum trading drove that. I think that inflation is going to be a little bit more pervasive than we hoped for. And it's why the 5 and 10 year rates are probably going to be a little bit higher than most of us were thinking a few months ago. And so why is inflation going to be higher? We can look at a Trump presidency and what that may do to inflation, what tariffs could do to inflation. That's definitely, it's a real thing. It's when you start just tacking higher pricing on, it's going to drive inflation. Now, hopefully, it has some other benefits, manufacturing, and hopefully, employment wages will go up. But all of that can stoke inflation, right? There's definitely a domino effect that occurs. So there's actually, I think more questions that I have in my head right now, more of and questions really just means a wider range of outcomes that I would have thought. There's more volatility, you could call it, more, that wider variance. And I think all of us are back to the drawing board as far as what do we expect next year? It's a question mark. And so that influences things. And then just quickly, and again, we'll dive into questions, but what does the Trump administration and policy mean towards our markets, mean towards inflation and interest rates? And it's one thing to say that we want interest rates to go down. It's one thing for Trump to say that I want rates to be lower. And yet when underlying policy would suggest that we need to have higher rates because of potential inflation. I think there's some crossroads there with what some of the policy suggestions and rhetoric are out there. We're obviously excited about the potential benefit of tax breaks, which could occur.
Very true. Very true.
And that's exciting. It's also inflationary to a degree. It can be as we put more money in people's pockets, and what do they do with that money, and how does that flow through the system, and the velocity of money, and all of those conversations. So again, just going full circle, I find myself thinking that we may have a little bit more pervasive inflation than I would have expected. As I was thinking about it a few months ago, I think that net, it causes a positive bias on mid to longer term rates. And I think that near term rates, we'll see what happens in the policy meetings, the Federal Reserve meetings that are happening here this month and next. I think we're all thinking about a little bit higher normal level than what we thought a few months ago.
Which is interesting too, because you're right. There's so many unknowns and outcomes that we don't know, but it is exciting because the things that we do know, like you said, are Trump administration's coming in. There's going to be some tax. Some tax positivity, I guess, especially for people in our space, which is, we're in the real estate space. And so is there anything that you'd like to touch on as far as what we do that's really exciting coming 2025?
Sure. Well, one thing that you mentioned, I know that everybody likes to knock the Federal Reserve when they throw out this data dependent comment, right? But it is data dependent. I mean, it is. And that's a fair thing to say. I think that there are other reasons to get frustrated with the Federal Reserve and how they act. But the whole concept of being data dependent is it's the right move. I also want to comment that although there could be inflation, the problem isn't so much that inflation will arise, it's being able to prepare for it. And it's with what speed and gap. You know, we talk about gap risk a lot, just generally speaking in the investment world. The ability for certain assets to really have these very meaningful movements higher or lower.
Yeah.
Okay, and how that impacts things. If things happen in a smooth, steady, somewhat expected line or pathway, it's not as big of a problem. You know, you can end up with an asset 10% lower or inflation, 3% higher. If it goes from 0 to 3 overnight, it's much more of a problem than going up a little bit, and then still ending at that 3% level. Yeah. So even though I'm talking about inflation again, and even though we're talking about interest rates perhaps ticking higher, there's the pathway aspect to it. And a couple of years ago, with the velocity that interest rates were increased by the Federal Reserve and how inflation really showed itself in the system, it was a lot, and it happened in a sudden fashion.
Yeah.
So it's not necessarily negative that we're talking about inflation or rates moving or trending higher, as long as it happens in a more muted and a more expected pathway.
Yeah.
So I just wanted to throw that in there. So as we looked at 2025, look, we may need to adapt our strategy somewhat based on the expectations for where rates will go and what will happen with inflation. I think that we were talking to our investors about how we were excited about the potential to refinance things at lower rates and how we weren't incorporating that in our models. It was just a positive option, which we may be able to benefit from, and maybe that's not there to the same degree. I think that there's a lot of buy the rumor, sell the news that happens in the markets. And if Trump's tax policies come into play, I think there's going to be a definite positive benefit net to the real estate world specifically that we live in. And I believe that some of the negatives of inflation, if we can game plan for those, it really won't be a negative. I still think the biggest issue that we have is there is some pain in our markets, and that any strength will be met with sellers. And I know that I've mentioned before that as we look at multifamily and gas stations, two areas that we're intimately familiar with, we were much more concerned on the multifamily side that there were some owners out there that were in a stressed state because of the market and really looking forward to selling as soon as they could. Yeah. And they were questioning how they may refinance their debt and would their lenders work with them and what type of pressure they may see to force a sale at a more distressed level. And I'm just not concerned, and I'm still not concerned about the market running away from us on a multifamily side in a positive way. I'm not concerned about prices really strengthening and building and looking back over the last 3 months and saying, wow, I missed the boat. Whereas on the gas station side, I did have more of a concern with that because more of the stress wasn't because of owners in a stress scenario. It was just because loans weren't materializing in that space. And it made it where sellers were selling at more attractive levels because they knew financing was difficult.
That was a unique time too.
It was.
That you're talking about right
It
now.
was.
And we took advantage of it.
Yeah, and actually as we look back at our purchasing over 2024, the best deals that we were able to consummate were in the summer of 2024.
Yeah.
And
that's vital too. I think people need to understand is being able to see that, recognize it, and move on it.
Yeah.
I think that's what Matt Denning does. So
That's what we try to do here at the firm, is definitely recognize that. Now, can be challenging for us because the deals today are still much more attractive than a couple of years ago.
Yeah.
The cap rates are much higher. The distribution levels, in spite of higher interest rates, are higher today than they were a couple of years ago.
Yeah.
Of course, if somebody compares it to a deal 6 months ago, they mean like, oh, it's relatively weakened versus that.
We're talking about gas stations too.
We're talking about gas stations specifically, exactly. But if you were to look at the longer term, you would say, well, maybe we're not at the lowest levels for buying versus 6 months ago, but over a multi-year period, these are still very attractive levels.
Yeah.
And I do think that if you look at multifamily and gas stations, again, two areas we're active buyers in.
Yeah.
I think the gas stations will continue to have strong appreciation in pricing as the tax code perhaps reverts back to those more attractive tax breaks. Depreciation advantages that the gas stations throw off. And so I do think there's a little bit of FOMO on the gas station side still that I have.
Yeah.
I wonder what those opportunities will be like 6 to 9 months down the road. They're very good right now still.
Yeah.
They were a little bit better over the summer. They're still really, really good.
Yeah.
And I wonder if this market could run higher.
Yeah.
Whereas in the multifamily side, I'm just not worried about it. There are too many owners that are sitting there in stress states, and it'll keep a ceiling on those markets, I believe.
Yeah. Oh, that's awesome. I think, go ahead, Matt.
When you're talking about the tax advantages, are you referring to the Tax Cut and Jobs Act?
Yeah, and what was generated from that exactly, and this accelerated depreciation.
Right.
The ability multiple years ago to accelerate your depreciable asset to 100% of the building value in the gas station side of things because of some special tax qualifications that gas stations fall into under some energy tax code, coupled with the Tax Cut and Jobs Act of 2017. If we can revert back to those 100% bonus depreciation days, that would be very exciting. That would benefit gas stations more than it would on the multifamily side. And why more gas stations in multifamily? Because of the additional energy tax cut qualifications that gas stations fall under. Gotcha. And look, this is I always like to say, it all comes down to the numbers, model it out. So when you model it out and you look at the tax break that the gas stations give you, that is real money that's put into the owner's hands. And so there's a reason why buyers are willing to pay more, because they're going to see that benefit on the tax side. So we are buying gas stations left and right today. We are all in on that for the right deal.
Yeah.
But we're still finding good deals. I don't know if I'll be saying the same thing a year from now or 9 months from now. I think I'll be saying it 3 months from now still. But going back to that buy the rumor, sell the news mentality, I think that as tax code there's more clarity there is a chance that this market really runs from us, which will obviously be good for everything that we've bought.
Yeah. Right. Yeah.
So we like that.
Yeah. Oh, that's great. Yeah. I think that's really interesting. I think, being able to recognize kind of the movement within the asset classes that we invest in is vital because, like you said, you have this micro view of where we're at right now, but you have a macro view of years ago and then also upcoming. Yeah. You're always playing that game, and we're both, data guys. We like data, and I love how you talk about the numbers. You got to break down the numbers and see what they're telling us, and make moves accordingly. So no, I really like that.
Yeah, and as I look at 2025 in general, I think it's good to take a step back and just look at general asset allocation across all asset classes. And through my career, that's been something that I've delved into a lot. I always like to tell the story about my time when I ran our emerging markets desk many years ago at AIG within the hedge fund, the fund portfolio. And it was always very difficult to buy in emerging markets and to convince investment committees to buy into emerging markets during difficult times when markets were down. Because there's always a reason why the markets are down. You know, Argentina is down 40%. We should buy now because you buy low and you sell high.
Yeah.
But then the investment committee says, yeah, but look at all of the reasons why it's down 40%.
Yeah.
Right? And there's a reason why, in general, investors follow price momentum strategies. When something is doing well, they like to put more money into it and to ride it. So let's, take a 20,000-foot view of what markets have been doing well and what's been doing bad and what is realistic as far as a rotation of capital. Because again, it is sometimes difficult to rotate capital into these sold-off markets, because people will say, well, there's a reason why the market is sold off.
Yeah.
So what's been doing well? Crypto's been doing well, right? Crypto is back in full force, and institutions are starting to get into that space. And you could see a story. You could see the story as to why that may continue. Tech stocks and equities in general. It's just shocking to me that equities continue to hit new highs. And there's no reason why from a price momentum standpoint, there's no reason why that stops. And let me talk about a couple of other asset classes and kind of go full circle here. So bonds, bonds have, when rates go up, prices go down, and so that's actually negative for bonds. But bonds have come back over the past year, although there's some volatility here recently. So bonds has been a mixed story here over the last 6 months. It was very bad for a couple of years. Then, and so I've mentioned how when things are bad, it's tough to get in. One of the reasons why institutions will get into markets that have been beaten up is when you can show these bands of, this is an extreme portion of the band. And so things will snap back, and there'll be a mean reversion component. So in equities, for example, you could say, well, valuations, PE ratios are at historic lows or historic highs. And when they hit those things, people start to question a mean reversion, and so they may counter the price momentum and go into those assets. So on the bond side, you'll look at historical bands of where yields have been. And so some have said in the past couple of years, well, yields seem to be hitting highs in a trend scenario, and so they could justify getting back in. It's harder to do that on the emerging market side. But when it comes to real estate, the question is, well, when will people start to feel like we're hitting an extreme that will mean revert? Because real estate has been a negative, has been a big underperformer over the past couple of years. Crypto has been good of late. Equities has been good for a long time, right? Bonds have been mixed. And so now you start to look at some alternative assets, some real assets like timber and what if gold and some commodity sensitive assets have done. They've done fairly well, right? But real estate has not. So what will tip people back into real estate to actually start buying and to counter this whole idea of, well, I'm avoiding it because the price momentum is negative? I think what we need to see is a big gap in supply where we have been overbuilt in a lot of Sunbelt areas. Now, let me just talk specifically to multifamily here, okay? So multifamily, there's been a lot of overbuild that's been talked about in the Sunbelt areas. We're in Dallas, and so we see some of that, but Phoenix and Florida and some of these areas. And so there feels like there's this gap right now where there's been pain in the market. There's been a reduction in rental rates that we've seen in various areas as that supply has come online. But we also know that over the past 12 months, new builds and the starting of the permitting process, because it takes 2 to 3 years, right, to get your 200-unit apartment up and running. We're starting to see this gap where there aren't any new builds, and you're starting to say, okay, 2026, I don't think anything's coming online in 2026, and what will the back half of 2025 be? I think if we see this multi-year period where people start to predict no new construction or no new units coming online, then I think we'll start to see investment committees and these big institutions start to say, all right, I can see the bands, I can see the lower part of this trend line, and how this supply dynamic will impact it to have a mean reversion of that asset class come back.
It's awesome.
I don't think we're there yet today, but I do think that you could see that coming over the next 12 months. I think that as people, again, choose to not build and to not put in for permits because interest rate volatility is still there, and it's all tied together. But I think we just need to see a little bit more pain, unfortunately, in the multifamily space, which makes it where new builds aren't starting to occur in that permitting process. And then, again, maybe later this year, people will say, okay, there's a 2-year gap of new builds. And I know there's still demand. I know that maybe there's a little bit of this immigration story and how the Trump policies could impact that. But people will start to do the math and say, all right, we're short on supply in 26 and 27, and let me start getting in. I also think we need to look at the office space, malls and conversions there, because we talk about how we don't see permitting on ground up new build construction, but we need to look at conversions. Okay. And that's another part of this element. And I'm not smart enough to know what will happen there and how the next 12 months will go. But we know the data points to look at to see how that will influence what the supply of apartments will look like in 2026 and 27. So, okay, we see the gap happening in a lack of permitting for new builds, for ground up construction. But what does it take to convert that San Francisco high-rise, that office space, over to apartments?
All those different shops that our people have seen are closed up, and there's a lot of them. I mean, even where we're at, I know a bunch of places that, that are closed up that could easily be converted.
It's funny. I was watching a CNBC clip. I'm from Rhode Island. One of 2 people out there in this country. No, from Rhode Island. And I remember writing a book report about this mall called The Arcade. Back when I was in junior high, I think it was. It was the first mall in the United States. In Rhode Island.
Wow.
Little fun fact.
Little
fun fact for the day.
First mall in the nation. Let's go.
First mall in the nation. And I believe it's a 3-story mall.
Oh, big mall. Yeah.
I mean, in Rhode Island terms, sure, it's a big mall.
It's the first.
It was the first. We're going to stick with the biggest.
Biggest and the smallest.
At one point, it was the biggest.
The biggest little state in the country with the biggest little mall out there. So I was just, they were talking about the conversion that this Arcade Mall has had on the 2nd and 3rd floors to apartments. So the first floor is still a mall. With shops, and the 2nd and 3rd floor apartments. And this conversion actually happened a couple of years ago. So it's not as if it happened today, but they were showcasing it just to show the success that it's had and the appeal that it has to certain tenants as they've converted that over. Bottom line, I'm just pointing out the fact that these conversions of some other areas of real estate, which have been, in a world of pain, which we don't traffic in at Harris Investment Group, but that office space, that retail conversion, and what could occur, there are a lot of eyes that are on that, and that will also dictate, obviously, the supply of units in 2 or 3 years out. And I think it's something that endowment funds and pension funds and these big institutional investors are looking at. If they start to change their tune on wanting to invest in this space, obviously that could really cause a big shift in the markets.
Yeah, for sure.
I don't think they're going to change their tune in a few months, but I do think the data will start to build up and become compelling, could become compelling as this year progresses.
Yeah. Wow. Jeez. I love it. I mean, I can sit and listen to you all day, Matt. Talk about the markets and everything that's going on.
Put you to sleep like the best of them.
No. It's all super interesting because it's all connected.
It is. It really is all connected.
I don't know about you, MattyP. I love listening.
Oh, yeah.
Whenever we get Matt Denning in here, I'm like, I can't wait to hear what's going on.
I know. It's exciting. I always leave with the feeling of, well, all right, there's a lot that can happen and a lot that will happen, and it could really go either way, but I always feel like I'm a little more educated with things as they happen, which is good.
Well, know that we're following it. We're looking at it. We don't know exactly how it will play out, but I think we have a good idea on what it's always about. I tell this to anybody who asks, what's the key to investing? You just have to identify the 2 or 3 major drivers to that asset class, to whatever you're investing in. You're not going to be able to predict what those drivers will do per se, but if you're following it closely, you'll be able to react. And most times these things are slow moving boats. It does. The change doesn't happen overnight, and so that's why you can get in front of it a little bit. You can anticipate it. Again, going back to the institutional world of investing, you hear this rate of change comment made. What's the rate of change? It's not the change specifically, but how quickly the change is happening.
Yeah.
Okay. And so they look for that rate of change. It's the derivative component of change to make investment decisions. And as they see the rate of change changing, I feel like I've used the change word too many times right now in that sentence, but that'll drive investment decisions.
Yeah. There's a lot of rate of changing happening right now.
There are inflection points. There are rate of changes that are happening. We're seeing it with interest rates. We're seeing it with inflation. We haven't even talked about the economy. On year 72, it feels like, of positive GDP growth. We had a little hiccup, but there are some surprising elements to this. It just feels like, those of us that are older, it feels like we're overextended in certain areas. It's odd that some markets like real estate have had such a correction in spite of an overall market that's seemingly going well.
Yeah, that's interesting.
It is.
Yeah.
It is.
Man. Well, thanks, Matt, for coming on the show today. And if anyone has questions, reach out to us, contact@harrisinvestmentgroup.com. We'll get those questions. And specifically for Matt, just put it in there when you email it in, and we'll ask those questions to Matt next time.
Yes, sir. Thanks, Matt, for being here. It's always a pleasure. I wish you had a crystal ball. We talk a lot about your crystal ball. That doesn't exist. Wish we had one.
Christmas is coming.
Hey,
that's true.
Is it on your list? And have you been nice?
It has been for about 23 years, though.
Oh, so well, maybe this 24th year will be
a charm.
Yeah, you never know.
What year is the year of crystal when it comes to marriages or whatever? Maybe I should
25?
just align my expectations.
No, 34. I don't know.
34. I'm going on year 25 in my marriage here, so maybe my wife should get me a crystal ball.
A crystal ball. I'll let her know.
Yeah.
You know what's kind of funny? You reminded me of when I interviewed and I was chatting with you. I found out you were from Rhode Island, and I remember saying, "Oh, I finally met somebody from Rhode Island."
There you go. There you go.
You're like, I'm halfway there then. One of two.
I met someone from every state. I just got to find the other one.
Yeah, you're almost there. The whole population.
Well, thanks, Matt. It's always nice having you on.
Thank you, guys.
Hope you find your dad.
Thanks, Matt.